What's up, everybody? Welcome to another episode. My name is Mike Hittinger. Today's topic is TFSA cheat codes. For those of you who don't know, a TFSA is a tax-free savings account. You need to be 18 years of age in Canada to qualify for one. In order to set one up, you can just go down to your local bank, assuming you have a valid social insurance number. It should be pretty painless. Typically within a few days you'll have your account. There's a few different things you can do once you have your account set up. You can leave money in there as cash. Obviously, money that's just sitting there in cash, it's good to have if opportunity comes up. Maybe you're saving to buy a house. Maybe you're waiting for the stock market to correct. There's a bunch of different things you can do with cash, but it's always important to recognize that cash sitting there, it's not earning any interest for you. And because of inflation, you're actually losing 3% or so every single year that you have your cash sitting there. So what a lot of people tend to do is to invest in various different assets. So a few things you can do with your TFSA is link it to mutual funds or a direct investing account. So what I do personally is I have it linked at a major Canadian bank. I bank with RBC, but I'm not sponsored by them, and all of the big Canadian banks have platforms where you can easily do this as well. Basically what you do is once your TFSA is set up, you set up a direct investing account, and then you're able to purchase stocks off of the market and earn interest that way. So what I've done is I have mine linked to the New York Stock Exchange as well as the Toronto Stock Exchange, and I purchase what I think to be fairly conservative stocks. I have some of the money in index funds, and I have some of the money into Canadian banks. All right, so what is the cheat code here? First of all, there's a couple of things that you need not to do with these accounts, and the first is to exceed your contribution limit. If you were 18 years old in 2009, your maximum contribution limit to your TFSA is $69,500. The limit has typically increased by $5,000 or $6,000 per year for every year, with the exception of 2015, when the contribution room for that year actually increased by $10,000. So if you were 18 in 2009, you can have up to $69,500. So the first thing you want to avoid is over contributing, because you'll have tax implications with the CRA. The second thing that you want to avoid doing is actively trading. And actively trading typically means day trading. And if you're doing this and you're doing it profitably, then you are going to set off some red flags with the CRA, and any earnings that you were thinking should be tax-free may be subject to income tax. So if you're using the account a little bit too actively, you might have to pay tax. So that being said, let's get to the cheat code itself. The cheat code itself is to invest passively and earn income over time. So with this recent market correction, there has been a ton of opportunities. When I first started thinking about this video, one of the things I was thinking of was dividend stocks, and specifically Canadian banks, which I feel is part of the more conservative end of the stock market. Once again, this isn't investing advice, it's just some thoughts and some things that have worked for me. You'll notice that I'll share plenty of things that haven't worked for me as well. So let's get to it. The stock that I'll use for an example is the Bank of Nova Scotia. I personally own 652 shares of Bank of Nova Scotia in my tax-free savings account. And the reason why I think this stock is an interesting stock is because of the dividend. So when I purchased this stock in early April, I ended up getting an average stock price of about $53 per share. So that means because they pay a dividend of 90 cents per quarter or $3.60 per year, that I'll earn about $2,500 a year of dividend payments. So if you're looking for passive income, what you want to do is set your dividends to cash, and you can collect the dividend every quarter. Now, for example, the current stock price is about $60. So for $10,000, you can buy about 165 shares, and those 165 shares will yield about $600. So at current stock prices, you can earn $600 of passive income every year for every $10,000 you invest. If you're fortunate enough to have the maximum contribution limit and you were interested in buying only this Bank of Nova Scotia stock, you could basically have 7 times that, or $4,200 per year of passive income. So that's one interesting way of doing it. Another interesting way of doing it is to have DRIP. And DRIP is essentially when your dividends automatically reinvest into more shares of that company. So if you received $600 of dividends per year, you would have $600 worth of new shares per year. And if it doesn't come out to an even number, whatever's left over in cash just gets deposited into your TFSA anyways. So, if you're young and you're not really looking to supplement your income just yet, I would suggest maybe considering leaving DRIP on, and then you can accumulate more shares over time. And when you get closer to retiring or just living off of your passive income alone, then you could consider switching your account and receiving your dividend as cash every quarter. So I just picked Bank of Nova Scotia. Obviously, there are a lot of stocks that do offer a dividend. The one thing to know is that dividend checks are not guaranteed, but some companies have a better track record than what other ones do when it comes to paying them out. Now, when I looked at Bank of Nova Scotia, one of the things that I found interesting is that they had not missed a dividend payment going back into the 1800s. I think it was like 1833. And one other thing that I looked at was, how did they do during the Great Depression? How did they do during the financial collapse of 2008, 2009? And it was interesting to know that they did not miss their dividend payments in either one of those market corrections. So, obviously we have a lot going on right now in 2020. The markets are, they're down from where they were at the end of 2019, but from what we've seen so far, they have been correcting. That being said, a lot of people tend to think that there's going to be another correction and we might not be out of this one just yet. So anyways, back to reinvesting the dividends. Do your due diligence. Find a company that you think's a good company. Find a company that you think has a high likelihood of continuing to pay out their dividend. If you're interested in this strategy, talk to your bank about their dividend reinvestment plan. But yeah, like if you invest $10,000, you could be looking at $600 per year of passive income. That's definitely a start. Like I say, if you're fortunate enough to be able to contribute close to the $70,000 into dividends, you could be earning, $4,000 or $5,000 per year of passive income. So that being said, thanks for checking the video out. If you have any questions, feel free to reach out on Instagram. It's at Mike Hittinger, same as the name in the channel. If you want to see more content like this, hit the like button. Please subscribe. Thanks for tuning in, and goodbye now.